Welcome, and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. In this show, we cover a broad range of topics that both cater to CRE newcomers and industry leaders alike. I'm your host, Ashley Kobovitch, and today we are thrilled to sit down with Marc Hershberg, Managing Partner and CEO of Topaz Capital Group. Before we dive in, a little bit about our guest. Marc Hershberg began his career at UBS Financial Services, managing clients' portfolios and debt placement of over $1 billion with affiliated banks, insurance pension funds, sovereign wealth funds, not-for-profit portfolios, and private equity partners. Before founding Topaz Capital alongside J. Etan Friedman, Mr. Hershberg worked as the head of originations and asset management at Brick Capital, a premier private equity and debt firm with $250 million AUM. At Brick Capital, Mr. Hershberg worked with the firm's principals, sourcing alternative loan financing and debt acquisition opportunities throughout major U.S. markets, primarily focusing on the New York metropolitan area. Mr. Hershberg holds a bachelor's degree from Yeshiva University and a master's degree from NYU Schack Institute of Real Estate. Mr. Hershberg is a frequent contributor to leading national CRE news outlets and spends much of his time involved in various Jewish and humanitarian-related charities. Marc, welcome to the podcast.
Thanks. It's good to be here. Really appreciate the opportunity to join you guys. And that was quite the introduction. I can't say I live up to it, but appreciate to be on the podcast with you guys.
Marc, I'm sure that you live up to it. I'm so excited to have you. Wonderful glasses. Definitely want to get those. Are those actual prescription glasses or are they just blue light glasses? Tell us.
They're actual prescriptions. It's not the first time I got that one. But yeah, they're the actual prescriptions, and I highly recommend if you're into glasses, Oliver Peoples all the way. They've been really fantastic, and they're really good with customer service. So all about that. I'm trying to talk my wife into getting actually the LASIX, but we'll see what happens. We'll see what happens.
Definitely let us know how that goes if you do that. But welcome. Thanks so much for joining us. Really appreciate it. Let's dive right in. So our first topic for our listeners, I know we just covered your background, but I'd love to briefly learn more about your career path and some of the lessons learned along the way. So let's start at the top. How'd you first get your start in commercial real estate?
It's a great question. So yeah, it all started out, really as a kid, growing up in the New York tri-state area, partly in a community that is heavily driven by real estate owner operators as well as servicers. So I kind of grew up with the conversations on weekends and social settings where, people were talking about real estate and or the real estate holdings if that wasn't their main, source of income or field of interest. So that was kind of a natural segue for me, kind of growing up in that environment. That being said, there's been a, kind of a personal interest that came along when I realized that I could take my passion and an interest in finance and leverage it into something that's tangible. And that was really what fascinated me. I really, was intrigued to learn that there is a field that not only could I, change the value of something, but I could also use my finance, economics, and capital markets, know-how and expertise to do that. And that was really, something that when it struck, I realized, when I had that, quote unquote aha moment, I was like, you know what, why am I still, in the finance world? Why am I still in corporate banking? Why am I still in the big banking space? Quite frankly, I also want to be on the other side of the table, the guys that are coming here, and seeing the amount of wealth they were making on the returns in short time periods. I was able to kind of track and follow some of our biggest clients, whether it was at UBS or elsewhere. So that was what's really fascinating for me was being able to see it and experience it at a personal level, at a social level, professional level, and coming out of school and seeing it through the corporate lens of a bank.
Sure. I appreciate that. And I'm sure that your background has lended you to have a lot of success here. But tell our listeners, maybe who don't know necessarily about debt markets and finance, what from your background drew you in specifically into that segment?
Sure. So, um, more specifically, I basically went into the space by, but more naturally, kind of by, realizing that there is a lot of, how should I say, real estate is a focal point to our economy. So, like, I started realizing kind of, top down, hey, what do we all need? What are the essential needs of life? And then I worked backwards. So housing obviously being one, food, and sustenance being another. And so housing combined with shelter, food combined with, you know, sustenance. And then three is, really, people argue what the third is, but a combination of having really just having a how should I say uh access to basic life fundamentals. So some people say education or otherwise, but those are like the two main things that people really need is sustenance and shelter. So that's really where I kind of took a step back and I said, you know what, this isn't going anywhere. This is something that's an absolute need, and it seems to be very recession resilient. So when I started seeing and hearing from people about, hey, what went wrong in '08, what went wrong in prior, downturns, to me, it was fascinating to constantly hear the same thing, which was multifamily real estate always lagged behind everyone else. And when you mention commercial real estate, it's a very holistic, encompassing terminology that's loosely defined by many, right? And the way we look at commercial real estate at Topaz is purely on a multifamily lens. And that's primarily due to the fact that we're a multifamily centric shop. So I hope that answers your question, but I really find that it's a space that um, like I said earlier, it's an essential need. Has proven out to be, has been around for thousands of years, going back to, archaic times. Talking, if you read some pretext, that's all mentioned there, and property and land and what have you. And I felt like that if it's been around for thousands of years, it's only going to be around for another several thousands of years to build a generational business if we can. So that's really what intrigued us most.
Absolutely. I'd bet on that, Mark, as well. So thanks for giving us that background. Appreciate it. So, looking into some of your mentors, will you give our audience a little bit of an insight into who were some of your mentors throughout your career and kind of how they shaped your path?
It's a great question. Wow. So mentors played a not only critical role, but more than integral. I mean, I would say, you know, all credit to Topaz's successes are tied to our mentors and advisors. And some of them there were my professors in NYU and Yeshiva University, or both. Some of them were people we met along the way, investors that took a keen interest in us, mostly CIOs of family offices, and or more institutional real estate, call it investment banking professionals, as well as generational real estate families who took an interest. And along the way, we try to, we always tell ourselves that we're not, we're constantly learning. My partner and I and C-suite we're constantly learning the business. We're young. There's tons of guys out there that are twice or three times our age that are doing what we're doing. And they're, for lack of a better term, they're stuck in their ways in so many first in so many examples that are running through my head. They're just very stuck in their ways. And the beauty of, I think, our shop is, while there is less experience at the principal level, we constantly lean on those that are more experienced and have a more open-minded framework. So that's been what the beauty of our collaboration. I would say, the mentorship is really more than just guiding, a professional. For us, it's been, deep relationship. It's been, hey, when you're backed into a corner, what do we do? when we're, when we're, when we're up against unprecedented circumstances, i.e., COVID 19, what do? We never been through this cycle before, and we never been through downturn and or call it pandemic infused recession or inflationary period. So that really allowed us again the opportunity to kind of lean back on our mentors and advisors, and we're so grateful that today we have I would say at least I could count on two hands the amount of mentors and advisors that we talk to on a frequent basis. These are experts in the field. We also have brought in people outside so they can look at our business through an exterior lens. We think that's critical to our success. Most guys in our field are kind of bringing guys in that are only tied and experienced to the field in which you're the investments in which you're making, and we think that's a major not just error, but we think that's going to end up ultimately being limiting your ability to see other perspectives. So what we've done is we brought in people from other types of commodities and finance, as well as S&P 500 type executives into the mix to bring a more collaborative, and ultimately what we've been finding is a more intriguing series of perspectives.
I love that. I love everything that you just said, not just that you have, so many mentors that you use, but just from all walks of life, right? To be able to see different perspectives throughout the business. I mean, an idea can come from somewhere out of the blue that you wouldn't even think of, or a person that you wouldn't even think of to engage. So, being able to have them inside is really awesome, and I love that you're so open-minded, not just with the company, but I think everyone can benefit that from their personal life as well, and getting different experiences. May or may not agree with everything, but might be eye-opening, and then you get a really good idea or a really good perspective. So that's awesome to hear. Tell our listeners a little bit about some lessons that you learned early on. I know you just talked about when your back is against a corner or looking at unprecedented times. So tell us an early lesson that you learned that became kind of a cornerstone or invaluable for you moving on into your career, moving forward.
It's a great question. There's so many lessons. There are so many lessons. I don't even know where to start. But one of those lessons I would say is communication. Communication, I always understood to be critical coming out of business school on undergrad, business school, and master's and grad school. But you know, I didn't understand the extent of it. Communication, not only being coherent but being concise, has essentially made my partner and I realize that that's a critical factor in us continuing our successful path forwards in the business. So when I say that is, it came at a lot of we've been able to eliminate rather a lot of you know tension and really could have been avoided tension, quite frankly, and things that tied to misunderstandings that we soon realized we had to work on. So as leaders or C-suites, or CEOs, whatever you want to call yourself, entrepreneurs, you have to constantly work on yourself too. And that's the lesson we learned was we can't just teach lessons and work on, help our employees work on themselves or help our partners work on themselves or work on deals to get, or how to make the deal work better. It's also working on ourselves. And that's also allowed my partner and I to share books, ideas, articles. Like we're all of a sudden talking about communication. We're buying psychology books. We're buying, books about like educate, like we're buying books that we never fathomed we'd be buying and reading and articles that we'd be
Yes.
subscribing to if it weren't for our recognition that communication plays a critical function of a successful company. And more recently, I'll also tie this out not just internally to the team, but externally to your investors.
Mhm.
Investors' communication in a turbulent, call it economy or a volatile economy like today, is becoming more and more and more crucial. So the concept of leveraging technology for communication with investors, leveraging we just launched a WhatsApp business account, so people could ping us really quickly on WhatsApp, which is fairly innovative. We don't know of many other shops that have done that in our space, where people could just ping us on WhatsApp if they can't get to us, as for whatever reason, via email quickly, which we haven't found to be a problem, but we want to add an extra layer of communication channel into the mix. And then, on top of all that, we've brought on an executive administrative manager to essentially help us, make sure that we're not missing, nothing's getting buried in the mix. Because when you're busy and you're building and you're moving quickly, as we all know, we tend to have things fall through the cracks, whether you like it or not. And it's not one of those things you could control, but it's one of those things you can mitigate. So that's what those are. I would say those are the communication umbrella lesson was critical and has continued to be critical to our success. And we're constantly learning. And we have some, it's actually great. It's a great, just small anecdotal piece is just to mention that, we have a couple family office investors and high net worth investors calling me, as they're also friends as well. And they're saying, here, I just want to tell you, your last report was great, but here's a couple tidbits on how we think you could improve. And he said that usually people respond to him saying, okay, thank you, have a good day. We took down the notes, we shared it, then we went back to him with questions, and we said, what do you think about this now? So again, there's so much to learn from every person. There's an expression that every man learns from each other, and the wisest man is one who learns from the other, according to Ethics of the Fathers. And we try to make that really our motive, our mantra here at Topaz.
Yeah, that's amazing. I took a ton away from that, and I'm sure our listeners did. And I'm kind of nodding my head here and smiling. Communication, I think, was probably the best answer I've heard yet on the podcast. Not to knock any of our other guests, but I think it's awesome in business, in personal communication, the way that you say things, the tone that you use, or the tone that's implied, even different grammar, right, that you're using, is coming off to the other person. So educating yourself, always be learning, I think, is another key takeaway from that. And always be open to feedback, right? A lot of people will get defensive if feedback is there, but take it in, consider, and always just continuously better yourself. If you look at my Amazon book history, you might think, hey, is this girl okay? A lot of self-help books, how do you do better? But that's really
We should
where
compare. We should compare and see who
we
looks
should
more.
we should compare books and compare notes. On that, I mean, is there a book that you would recommend? Kind of your number one in terms of communication? What would that be?
So I would probably say, that's a real tough one because I'm in the middle of so many
Sorry to
right
put
now.
you on the spot here.
But
I'm sure
no,
there's a lot.
no, not at all, not at all, not at all. I would say Brainy Brown is a great book. I mean, a great author for a specific book that I think is a great self-help book called Daring Greatly. And it's tied to the courage of vulnerability and how that transforms the way we live, the way we love, parent, lead. And I think what's so beautiful about that book is you can apply it to every facet of life. I know I just mentioned 4 facets of life, but you could literally apply it to every facet of life. And it's been a phenomenal learning curve for me. I'm towards the latter end of the book, so I'm not done yet, but I'm almost there. And I found that book to really help me see things through a new lens.
I love that. I just ordered on Amazon.
Yeah, I
it's
mean,
not it's not sponsored, y'all. It's not sponsored, but it's ordered.
I mean, it's all the more a case of why everyone should be ordering them. And just so you know, we're actually going to be trying to get this for all of our employees as well and partners. So next, we're going to be selecting our favorite book of the year for self-help, and then we plan to distribute that out as well. So that's another thing that we feel like if we're doing it for ourselves, we should also be doing that for our partners and investors.
I love that. That's an awesome initiative. Speaking throughout your career, obviously, a lot of lessons, a lot of mentors. Do you have any favorite mistakes, so to speak, Marc, or moments that course corrected you onto your current path that at the time maybe you didn't recognize was an actual opportunity?
So many mistakes. The thing with mistakes, I just try to not make them more than once. But obviously, there are times, most of my mistakes are made more than once, sadly. And I think it comes down to twofold: self awareness and tracking how many times you've made that mistake, or being more cognizant of those um, of those mistakes made, rather. So if that dichotomy going on is how I try to tackle mistakes I've made. There are times where the mistake, you can't necessarily walk yourself out of it or back out of it. You just have to bite the bullet and move on. And sometimes those mistakes have costed us an investor, multiple investors, operating partners, deals. We've been experiencing that across the board. However, when mistake is finally corrected and usually done 3 times, not that mistake was not done again, I find that pattern usually falls out of the wayside. So you already have started to grow and learn from that mistake. That's been the measure that I found, is the 3 times from the last time you made that mistake, you didn't make it again. And then you're usually in the clear. So that's when I try to, free up the brain space and say, hey, and that bandwidth, and say, hey, you know what? Let me put aside the concept of, this particular mistake that I'm tracking, and let me start tracking the others, because there's a nice list of them, and you can't tackle them all at once.
I hear you. I love the self awareness piece, but also, and maybe take this into consideration, but, reward yourself potentially when you were in a situation and you could have done one thing, you recognized it, you didn't, and then you said, okay, I chose to do X instead of my typical downfall of Y, or, something like that, to reward the positive behaviors and habits as well. Little
That's that's a,
reinforcement.
that's a great point, and a partner does help you do that. Having a
Right.
good partner, a good, honest, and complimenting partner, really does help you do that. For those that run companies themselves, I can't speak to that. I'm honestly very impressed by those individuals. I don't know how they do it, but what I do know is the checks and balances, and the positive reinforcement that we give to each other as partners, when we're not making the same mistake more than twice or 3 times, is really something that helps us helps us do exactly what you just said.
Absolutely. I love that. For moving on into our second topic of the day, covering your unique perspective as a multifamily investor in today's commercial real estate landscape. So, first point, to provide some context, what is Topaz, and what are your team's investment ethos and mission?
Great. So Topaz is essentially a multifamily centric firm, based out of uh, primarily New York and Miami. We are at this point, as of 2023. Historically, Topaz has been a just multifamily centric shop across the board, pretty much nationally. Over the years, we've honed in on certain geographic regions, certain project scopes, sizes, and levels of complexity. We've also um, tried to hone in on those, uh, you know, asset class, like the specific property types that we can continue to scale on. So we've essentially chosen garden style, community type, rental community type living properties. And what that's done for us is allowed us, and part of our mantra is, you know, growing wealth and creating communities. And the idea of that is that, we believe that the community starts on a more micro level, and then, the that aggregation and the compilation of all the communities, the rental communities within a market, within a city, within a greater, call it even sub-market of a city, will have a large influence. So if we bring a higher quality of life and access to education, which we do, we try to provide, free internet in the clubhouses. We give, or we give access to computers in most of our properties, so people could, browse and educate themselves. And if they want to pay their bills and their rent, great. But if they, want to also just browse around and learn and get educated and surf the web because they don't have access to that, we're more than happy for them to do so, and they have been doing so. So that's really phenomenal amongst our Class B assets. Our Class A stuff, is more, higher educated individuals with some reserve money, and in those cases, our perspective is to continue to basically make them, continue to make them as uniform as we can across all the Topaz owned properties. And that's partly part of our branding strategy, where we put Topaz in the name of all of our properties. At least there are exceptions, but for the most part, we tend to bring the brand into the mix on all property acquisitions. And the primary reason being is that we can usually play off of economies of scale. And once the Topaz brand, as residents across Florida, because we're Florida focused acquisition geographic, firm, as they become more familiar with our brand, they typically tend to go to look at our properties in other sister city markets. So they'll go from Orlando to Melbourne to Lakeland to Jacksonville, to you name it. I mean, it's pretty cool to see that they're already calling those managers and saying, "Hey, what about your sister property up here and there and and elsewhere across Florida?" And so that's been a fantastic marketing strategy and corporate strategy at the company that we've been seeing early successes on. Furthermore, we do want to continue to grow and do more institutional type deals. To date, we've been more in the setting up the foundation as opposed to really scaling. Granted, some argue that we've scaled very quickly, and we've scaled at the pace that it looks like we were in a scaling mode. Quite frankly, we weren't. We were doing 3 to 5 deals a year, digestible, and making sure we're taking them on to asset management and operations at a slower pace than diving in and buying larger portfolios or doing multiple acquisitions at once. And that's also been a critical that's been critically important to us, because our desire long term is to stay a lean and mean team. We would like to stay a team that just really stays strong amongst each other and focuses on the relationships and not becoming a volume shop. So that's in a nutshell how I would describe Topaz. And the last 5 years of running it has been amazing. There's been ups and downs alongside my partner, but a lot of kudos to my partner Eitan and the whole team at Topaz. It's really not possible without you guys. It's the amount of obstacles we come across are just beyond comprehensible at times.
That was a fantastic background. Thank you so much for that. I know you touched a little bit on some of the strategies and some of the changes and things like that, but let's dive into any additional ones, especially given the current market changes. How are
Mhm.
you all setting up Topaz for success? So, in external investing strategies and changes versus internal optimization. Can you dive a little bit into each? Anything else that you would add in addition to the overview that you just gave us there?
So that's a great question. I think it's very much tied to the goals and objectives that we set forth for the year. We basically laid out our core competencies today, and then looked at our core competencies that we want to achieve by year end, and we started looking at the discrepancies between the two, and we're hoping to bridge the gaps between the two. And one of those gaps, I would say amongst those, one amongst a few examples amongst those gaps are rather, our trends. And I'll talk about specific investment strategy first. I'll tackle that. Our transaction-specific goals have shifted this year to larger MSAs with better located assets within the MSA in a time where there's more volatility and in valuation as well as turbulence externally, as you mentioned. The the sole focus across Florida is also helped us become not only more of an expert in the state, but it's also allowed us to become really a resource to the brokerage community, to the servicing community, where they know Florida multifamily is becoming synonymous, with Topaz on the acquisition side. It really allowed us to now receive a very high level of deal flow. And that high level of deal flow allows us to, I should say, inconspicuously share, inconspicuously and also at a high level without giving away information, because protecting brokers and protecting buyers and sellers is critical in our business. That's how you make and break a reputation. But being able to give high level intel on, hey, I've already seen this deal before. Hey, I've already, I know that neck of the woods and this is your main obstacles there. I know, so a lot of brokers confide in us, and not just brokers, but buyers in the market are starting to confide in us. Not only from New York, we historically, New York, California, Chicago, were all confiding in us as, hey, you guys were one of the first ones to come out of those states and to dive into multifamily in Florida back in 2018 and 19. We said to them, it slowly progressed to, it quickly rather progressed to, hey, we're a local shop. We could use your take and your perspective on this deal. So that's been a really fascinating observation on our end, and we're very proud of that. As far as deals, obviously, as we grow, we have less, and we want to stay lean and mean. We have less time to do volume. We don't want to become a volume shop, so we're doing only 150 plus units. Typically, the bigger the better. If we could take down 400 or 500, we're looking at a few recaps and purchase and acquisitions that are north of 400 units, all of them, quite frankly, besides for one. And so that's another element to our how we're looking at dealing with the new environment of today. We're also looking at deals that are more, being that capital markets plays a massive role in your ability to get deals done today. We're looking at deals that those not only that our LP equity investors are going to be intrigued in, but we're also looking at those deals that we know are in proactively talking to our lenders that we know they'll finance. So that way we don't cost face with our brokers, we don't lose time. So we basically do upfront due diligence on what deals will get funded both from our equity investors and from the debt and from our lenders. And then once we have that comfort level, then we proceed. So that's been another tremendous pivot for us and refinement of our platform on an internal level. And I would also say that we want to also try to diversify away. Insurance has been a concern of ours well before it became a hot topic, and we've always said to ourselves, we don't want to be in a position where we're on beachfront, beachfront, coastal front, and we are going to be whenever the carriers pull out, which happened quicker than we thought it would, but it still happened. And we don't want to be in a position where we can't get insured. So historically, to our credit, with exception of maybe one deal that's quasi in or outside of a flood zone, we've managed to do that. And so we're less susceptible to today's big, how should I say, wild card of where in the world is insurance going in the Southeast. That's been a huge, and it's still an ongoing discussion. We have no idea. I'm not going to tell you we have the secret sauce or secret answer. But what I can tell you is that we mitigated ourselves as best as we can by not being beachfront on any of our assets, and also being in newer construction deals that typically have more durability. So that's been, our outlook since 2019 essentially, and continues to be the key today. And I would say the only thing we've really done is now we're taking maybe a closer look at it. So
Mhm.
we're, the new expression that people, I think you'll appreciate this, that we're throwing around the brokerage community and actually across the entire industry, is that it's no longer a tax adjusted cap rate. It's now a tax and insurance adjusted cap rate. So we're actually our own shtick now is that we want to create some swag that says tax and adjusted cap rates only, because now insurance is such a wild card that it could throw off a deal just as much, if not more, than taxes can. So that's how we're essentially. Those are the main kind of pivots we've made into the new environment in order to mitigate a lot of the turbulence, external turbulence. And obviously, new construction product is. A lot of developers were delayed due to COVID or post-COVID, due to financing, due to construction, appliance, supply chain, all types of issues they've faced with that I really sympathize with, both as friends to developers and someone who is looking to co-GP in the development space, which make me segue into a small tidbit about what we're offering at Topaz for developers in Florida multifamily, which is we're allowing we're loaning up to $2 million in pref money, pref dollars onto new construction deals if they could show us how the sources of uses of the $2 million will get them to get them to CO, to certificate of occupancy, and get them to be able to sell it upon stabilization. And obviously, in turn, we ask for a slight discount to market, but in turn, the developer also gets to free up cash, start their next projects, or continue and complete successfully their current project to not have a blip on their record, because developers are essentially against the greatest race of time when they're developing. And many cases, $2 million up, pref money up front, with also having the certainty of execution by Topaz as the acquisition, as the buyer, upon certificate of occupancy and stabilization, has made a very attractive and compelling case, and an alternative to rescue capital for developers.
That's awesome, Mark. I hope that our listeners are taking your information down right now. We'll definitely give it at the end, but that's an amazing incentive that you all are offering. And thanks so much for giving our listeners such an overview of how you guys have been able to pivot, what success you've already seen from it, and then, obviously the long-term implications. And when you start that business of creating the shirts and the hats, definitely be sure to send one my way. That'll
Definitely
be a new
will.
income stream for you guys. But that's awesome to hear. Really, really appreciate everything that you're doing, and that incentive is awesome. Anything else that you want to talk about? Any specific 1031 exchanges, or any opportunity zones, or any programs that you guys might be offering, or anything else? Or did we cover them all?
We actually have a very popular program that's related, but not quite. It's more affiliated to our parent company, which is Topaz 1031 LLC. Topaz 1031 is basically a one-stop shop for all 1031 needs, and rollover needs, by investors into multifamily assets, primarily in the Southeast, obviously, given that we're a Southeast investment shop, multifamily centric shop. So what does that really mean? It means that, for investors that have over $2.5 million, we basically, have uh, created a not only deal pipeline, a constant stream of deals for them to look at and opportunities for them to come into. But what we've also done is allow them to come into more institutional grade assets. By it's essentially becoming the alternative to triple nets and DSTs for us, in our eyes, and that's how we're spinning the product. Is that it really is your alternative to DSTs and triple nets, but the difference primarily being that you can get the actual upside. So in a triple net and a DST, you're capped basically. You get your increases, you get what you get. DST is a fee business for sponsors, which I'm not knocking on, but it's a fee business, and investors don't really make much money in it. They're just preserving their wealth. and the and the and the I would say triple nets are what they are. I mean, you're buying your classic retail or commercial space, and you're just basically clipping a coupon with no upside. So, the tick approach, the multi-tick prong approach that we took under Topaz 1031 allows investors to come in under our institutional sponsorship and get into investing into more institutional grade assets. And what that does is allows them the upside, allows them the asset appreciation. The What comes with multifamily as well is, which is a huge perk to many 1031 investors, is depreciation of the asset, accelerated depreciation, which this year obviously we get into has gone from 100% to 80%. But point being is that it's still a very strong case to be made for depreciation. And I would say also allows for future 1031 rollovers. So when Topaz has a future opportunity and they present it, there's an opportunity for those investors to roll over into a future asset, as well as it allows us to have a team where Topaz basically has a legal, tax, and accounting 1031 team readily available for any and all questions through one email. So what that's done is basically streamlined all communication on 1031 questions. It gets highly complex, especially if these are legacy properties, which many times they are. But at the same time, it's nothing that our law firm and or outside law firms haven't tackled before. And what we've also done at just complimentary is advise people. We'll give you a list of QIs if you need them, qualified intermediaries rather. Sorry for those listeners that don't know what QI is. Your qualified intermediaries, which you need to use in a 1031. Your top tax attorneys references in the country for you to review. We'll give you the accounting for you to review. So we'll give you all of our contacts and let you make your own decisions. And sometimes we have people that say, hey, it's this is something you're gonna knock your head on, you won't be able to get around, and that's when we love them. We love a good challenge. So so long as it's above $2.5 million cash position, the debt's less relative as long as it's not a 4x on debt versus cash or some absurd ratio. We've typically always found a solution for those investors.
That's awesome, Marc. I love that you're able to give us those benefits, and listeners definitely, reach out for more information. We'd love to get you guys connected. So, moving on to our third topic here, Marc, as we navigate through all the changes so far in 2023, what is the current state of the multifamily market? What's some of the most significant changes you've noticed as an investor in the last few years, and which will have the most lasting impact forward this year?
Wow, what a loaded question.
What a loaded question. No
um,
pressure.
Multifamily for this year. Our outlook is essentially, I guess I'll start with our outlook. The Topaz outlook, for the most part, is, and I'm hesitating to say this because I want to make sure that everyone understands, that we just went through an unprecedented time. Well, when I say unprecedented capital markets experience over the last 9 to 12 months, I'm referring to the last 14 years. We haven't seen something like this, where rates were basically zero, right? So we basically had, free capital for a large part of the latter end of 2021 into 2022. And, shortly after, realizing that we're hitting an all-time high in inflationary and supply chain issues, started gaining, and for essential goods as well, started creating a lot of pressure. And then on top of which, you're looking at gas prices that are going out of whack. And as we all know, garden style properties are typically dominated by people driving their own cars and or those of their spouses or relatives. So there's it's been a really rough year for middle class America. In short, they got squeezed on rental rates. Capital markets went wild. Inflation has squeezed them out. Gas has, house pricing has, And so obviously that drove a lot more traffic to our rental properties, because for the units we have that are, 2 bedrooms or larger, families are saying, you know what, we don't have an option. This is a rent by necessity more than it's a rent by luxury. So that's what we've been kind of seeing over the last year. We, to give you one anecdotal piece on a great example on a war story we went through recently, is we signed up a deal back in early, call it 2022, at all in, call it 210, at a 210 rate, sorry, a 2.1% rate. Okay. Obviously there's a limited recourse component, in order to get get a rate that low, but we essentially pro forma'd out that even if we hit a rate cap of 5.5%, it wouldn't happen for at least a year or 2 years. Well, little did we know that the market had its own plans. And the plan the market took was the escalation, and mostly the Fed, obviously, driving all these decisions, to escalate rates at the highest pace that we've had in over 14 years. And it was done essentially 6 months. It was a 2x on where rates were prior, 2 plus X on where rates were prior. So what that did is made us essentially hit our rate cap within the first year, and hit it not only in the first year, but also hit it at such an accelerated pace that we had to then pivot and say, you know what, we actually do have to do a little more robust value add plan, in order to keep up with, the new debt service payment, because it's more than doubled. So that was a good test to how good of asset managers, owners, and operating partners do we have, and where are we looking at that deal? Because you have to pivot. You don't have a choice. Like, the markets drive. One of my mentors, credit to Joel Radman. That's a quote from Joel Radman, former boss of Brick Capital, now partner in a few assets in Philadelphia. And Joel always said to me, you can control a deal, but you can't control the markets. And deal's business plan, rather. And, that stuck with me. And I've echoed that to the entire team, including my partner, Eitan. And we basically said to ourselves, if that's the case, then, we really have to pivot every single time the market, pushes us to. We can't just stick to the same plan. So we revised business plans on a few of our deals, which gives no investor comfort, obviously, because no investor wants to hear you're pivoting on a business plan when they originally subscribed to something slightly different. But at the same time, it's the confidence in the sponsorship. It's the confidence in the partners. It's the confidence in that we are. It's our ability to adapt that makes us greater than our competitors. And I think that's been something that we've been tested over and over, constantly being tested right now as we speak by this. Provide that talent density and scale up. Sorry, and trade up in terms of talent, as well as trade up in terms of your assets in your portfolio. This could be a very, very painful period over the next, foreseeable future.
Sure, absolutely. And kind of going with, the topic that we're a little bit into right now. I mean, what are additionally some of the challenges of being an investor right now? And how is Topaz looking to navigate those challenges? So maybe having to spend capital in a specific time frame, but still determining how deal variables will change during negotiations or due diligence, et cetera. Maybe even touch on, especially how it comes to 1031 exchanges. So maybe dive a little bit deeper into that for some of our listeners.
Sure. So, um, just wanted before I dive in, I want to just, you know, want to make sure I'm going to give our listeners the best response I could give them. There's so many challenges of being an investor right now. I have to say, and I know that's kind of, it's stepping on my own. I'm stepping on my own foot by saying this. I'm putting my foot in my mouth, rather, because I'm a glorified capital raiser and asset manager and owner of multifamily. But at the same time, investors have to be incredibly diligent the investors that have greater diligence in today's environment and level of conservatism will be the investors to have experienced the least portfolio pain for themselves. And it's hard. It's not easy to say, hey, I'm gonna have to pass on these opportunities when I'm used to participating in them. It's not easy to tell an investor to change their modus operandi and their way of doing things for years. But at the same time, we do tell our investors that, first off, we don't want your money if you're investing more than 5% of your net worth. That's A. So we're also changing our position and saying we want you to deploy less of your overall capital into real estate, even though that does give us less ammunition to invest those and deploy those dollars. So that's that's the advice we've been giving our investors. We've also been, how Topaz is looking to navigate those challenges is really by continuing to do what we've been doing, which is being ultra conservative. Just, if you can't sensitize your models to, if you can't sensitize your models to a more, a 15% reduction on your cash flow, and you can't discount your cash flow by at least 15% and you're still covering your mortgage, or 20% you're still covering your mortgage at a 1-1 or 1.15, you should probably not be doing the deal. And also we're looking heavily at return profiles. We're now requiring a slightly higher return profile, which I know the brokerage community doesn't want to hear, but the reality is we are requiring a higher return threshold, and I'm just very candid. Everyone else I'm talking to is also requiring it, but they're not telling the community that because they want to still see all the deals and just get the blast. But at the end of the day, we are requiring, and a good example of this is actually, I'll even hone in further and say we're now requiring 2% higher across all IRRs, from value add, turnkey to core plus, and core to core plus strategies. So we're slightly increasing our IRR return threshold. So furthermore, we're basically finding ourselves in a position that our yield on cost is also, we're solving for a higher yield on cost, essentially. That what does that look like? Historically, most investors, including ourselves in the multifamily space, were at it, call it 6.5%, building to 6.5%, call it upon stabilization. We're now at a 7.5% plus yield on cost upon stabilization, which, for those listeners that don't know what yield on cost is basically just your total project cost, tied to your debt. So, basically, what we're finding is that, and when we took a poll from our investors, because your investors are essentially your lifeblood, and we went out to over 6,500 people according to our e-newsletter feedback, and I would say about almost half of them responded, about 40% response rate, and they were saying that their average cash on cash is also critical to them at this point, a juncture in time when their own stock portfolios up until last year was in the golden era, if you will. So the average cash on cash that we historically were subscribing to our investors were subscribing to, rather, was a, call it 7.5 plus. In today's era, we're calling it at an 8.5 plus. And that's really because there's less certainty there's less clarity and vision in terms of your exit. Obviously turbulent times, you don't know when, markets are going to teeter back down and, or teeter back to, on rates and start, picking up in terms of economic activity. But what we do know is that as long as your cash on cash is strong throughout the life hold of the deal, and your leverage point is conservative, which we typically have a portfolio blended of no greater than 67%, which we think is very conservative. And on new deals, we typically tap out at around 65%. So, we basically say to ourselves that that's what our investors are going to need in order to go into a deal today. And, that's not only helped us and helped our investors be in a less, call it less risk exposed position, from a liability standpoint, but rather it could ensure that we continue to look at deals with a longer term lens, and we continue to bring those same investors and make sure they repeat into the long term. So that's how we're looking at our own return thresholds in terms of raising the bar, and then that's been really well received by our investors to date. Obviously, some of them, as we go out to meet more larger institutional LP equity check writers, we're finding that some of them are more focused on other aspects like IRR. But for one check deals, obviously, it's a very different conversation than your syndicated retail investor, um, you know, type structure. So that's how we're looking at the market today. And we're just telling investors, please be extra diligent. Please take extra time in reviewing materials, asking questions. And if you don't get the answer to the questions, then wait till you do, or find out from someone else what they're doing. But don't just, say, hey, because seem like nice guys, let's just dive into the deal. Or, seem like nice people, dive into the deal. But one thing I want to also give a quick tip to investors on, because it's something I'm constantly reminding myself to do, is stress your deals on an unlevered basis as well as a levered basis. Look at what your deal looks like without debt and what it looks like with debt, and see if you feel confident that, because capital markets is the wild card, I'm basically telling you to isolate and yeah, really isolate and ultimately siphon out the debt component and look at where the deal will return you. And if you could do that on your deals, as well as run some sensitivities analyses, I think you're gonna be in a prudent position to make some good investments for the following year.
Thanks so much, Mark. We really appreciate it. That was an awesome insight into how our investors can navigate this market, what to look out for, and really do your homework, right? I love that. Don't dive right in. I personally love the song "Fools Rush In" or whatever the actual name of the song is. One of my favorites, but don't be that fool that rushes in. So, thanks for giving us so much of that background. One last question from an investor perspective, Mark, if you don't mind. How are you navigating the bid ask gap between seller expectations and buyer specifications?
Wow, I think you could ask Luke that one, because we just worked on a deal together. But we basically are finding that the gap is tightening a little bit, but it's not tightening as quickly as we initially thought, or at least the multifamily community thought in the Southeast. Granted, nationwide, I would say that the bid and ask gap is more tied to the more sought after markets. So the more sought after the market is, the greater the bid and ask gap remains. And the less sought after the markets, the more those are shrinking, because those sellers have less, have less of a buyer pool, have, less of, call it maybe some residual, rental rate growth, or, some other things that have been helping them kind of carry their cash flow. But, in terms of like Florida, for example, because that's really our, mainstay and backyard for acquisitions. Um, we're kind of, seeing right now that the ones that have to make decisions today are bridging the gap. The ones that don't have to make decisions today are not bridging the gap. They're saying we're gonna wait and see pattern. So NMHC this year, which is obviously the big, for those who don't know, it's a big National Multifamily Housing Council convention in Vegas, and sometimes in Florida they switch off. It's an alternate convention and conference, but in short, the sentiment that everyone took away was deal volumes down, and the gap is still very wide across the state of Florida, for those that can hold on their assets longer term. So those that are not coming up across, uh, you know, mortgage maturities, Those are now coming up against tax reassessments, large insurance reassessments, large um, another thing we're seeing very commonly actually right now is like I said, not getting rate caps on their deals. Those that have um, taken floating rate debt but put on a very large rate cap, so they had to do it for loan purposes, but they took you know, a 450 spread because they wanted to pay a very small premium up front and on the deal, are now probably kicking themselves and saying, "Oh, I should have paid more." Or those that, in my case, I was trying to be talked into by some people to try to only cover, because it was cheaper of a premium to put the rate cap on in the entry of the deal by only covering, let's say, 70% of the total mortgage. Luckily I stuck to my guns and stuck to our intuition and our advisors and my partner's intuition, perspective of, no, we're not going to do that. If we're going to run a rate cap, we're going to run it, we're hedging ourselves, we should hedge ourselves the right way. And a lot of people didn't do that. So we think that there's a lot of pain. People are, some cases it's shocking, but people are going to HUD lenders and trying to figure out if they could get money out through HUD, because they obviously have a more they have an ability to provide more proceeds and a longer term amortization, etc. So, and a slightly lower rate in certain cases, if you could fill within those HUD programs, satisfy those HUD programs. But essentially, we're in an era where people are trying to refinancially engineer their entire deal, um, and also figure out and how to tighten their operational excellence or lack thereof. And if you could do those two things, you'll be fine and you'll come out on top, is what we're being told ourselves. And we're also being told, if you can't do that and you don't start taking proactive measures today, this could be, your last rodeo, or you're going to have to pivot into something else down the road. But there is a lot of pain coming. Being close with your lenders is really, really important, and you're hearing it from a non-lender. I mean, I was historically a lender, but you're hearing it from really someone on the equity side, that the close relationship you have with your lender and your asset managers and your and your point of contact, your relationship contact at your lender, is becoming more and more critical to your success. And that doesn't have to mean um having breakfast or dinner with them every single day, but that does mean starting to build that rapport even further and show some loyalty to that lender, and show them that you're not just working with them, you want to work with them. And that's the key, I think, to today more than ever, is more than any time that I've been around. And it's been a short, obviously, we're young guys, don't really talk about our age so much, but we are under 30. And we really can't afford to fail as a company. So we're really looking at this as, hey, how do we continue to lean on those who've been through these multiple cycles? How do we continue to lean on those operators that are most effective, and really help you know deal. And another piece is really operators that are large enough to help you tackle and mitigate this huge wild card of insurance concern that's going across the board, or what people call insurance wildfire in some cases, is what I've been hearing as a trendy topic. So that's really what we're seeing from our end in terms of what people can do to ensure that this year is a year that they're going to grow stronger. Because, and I hate to say the cliche, but what doesn't kill you makes you stronger, is essentially what we're finding to be resoundingly true for this year and going forwards.
Awesome, Mark. Really, really appreciate it. You've given our listeners a ton of insight into a lot of different topics that we covered today. So, thank you so much. We really appreciate your time. We know that you're super busy. So, how can people find you if they're interested in connecting more? Email, LinkedIn, give us all the deets.
Sure. First of all, it's been a pleasure. You guys are awesome, and the team is awesome, and I'm very glad Luke introduced us all. The best way to get in contact with us at Topaz is, info at a more general level and general inquiries is info at Topaz, TOPAZ, CG as in Capital Group.com. And we'll get those, that gets circulated to everyone on the team, and then those emails get properly routed from there. And in terms of social media plugins, we're on everything from your LinkedIn at Topaz Capital Group, Instagram at Topaz Capital, and Facebook at Topaz Capital Group. So please follow us. Please share content, comment, join us in conversations. We're constantly uploading intel. And last but not least, please visit our website at www.topazcg as in Capital Group.com. And if you don't know, you can look at my hat right here. That'll tell you a little bit more about how to spell our website. And please subscribe to our e-newsletter. There's a lot of multifamily related information coming out of there, not just for Topaz, but for the multifamily sector as a whole. And we try to do very informative polls and free giveaways, which is always exciting, and lots of fun activities that go on there on the e-newsletter side of things.
Awesome. Thanks, Mark. I know that our listeners are definitely going to subscribe. Who doesn't like free things? So, of course, I'll be in there. I'm just kidding. I love all the content that you guys put out. We'll definitely be subscribing. And thank you again so much for hopping on. It's been an absolute pleasure.